So there is this cognitive dissonance. I think it's very important. People are not prepared for what's coming, I believe. Yes, the answer is yes. I do agree with the Atlanta Fed. We're going to have a second consecutive quarter of negative real GDP growth, which means we're literally in a recession. As defined by the NBER, that's the technical definition of a recession, 2 quarters in a row of negative real GDP growth. Now, the real question, David, is this a prolonged recession? How bad is this recession? And what are the effects on your portfolio and the economy? Now, Goldman Sachs put out a table last, I think, week that shows that the average or the median recession over the last 50 years has lasted 4 quarters and has seen earnings drop by 14% on average. And now analysts out there are expecting earnings in the S&P 500 to grow by 9% this year. So there is this cognitive dissonance. I think it's very important. People are not prepared for what's coming, I believe. So what's coming is that if I look at any of my forward-looking indicators out there, I have a bunch of them. So let's talk about the credit impulse, for example.
Yes, let's talk about that one.
So the credit impulse is a series I developed. It tracks the amount of spendable money that we get on our bank accounts, we as citizens, corporate citizens, households, and it tracks whether this amount of money is increasing or decreasing across the 5 largest economies. And why is it relevant? Because the more money we get on our bank accounts, the more likely we are to spend some of those and to foster economic activity. So when this credit impulse goes up, if you give it a lag of like 6 to 9 months, then also economic activity will pick up. When the pace of creation of this credit slows down, then also economic activity slows down. You can see that in that chart. The global credit impulse went through the roof in the first quarter of 2021 because governments were sending us checks. They were cutting taxes. They were making sure we had more available money at our disposal. Well, fast forward 9 months later, in 2021, earnings to the roof, GDP to the roof. Now you go to 2022 and credit is drying up. Mortgage rates have gone through the roof. So if you want credit to buy a house, it's much more complicated today than it was a year ago. So credit impulse drops. And what happens is that normally earnings will also drop with a 12 months lag, which is between 2022 and 2023. And the scale of this drop seems to be very, very large. And I don't think analysts are pricing that in. Also, if you look at any other survey, forward-looking indicator survey, like the NFIB survey, the Philly Fed survey, some of these prints, when CEOs or small companies are interviewed, David, they're asked, what is your outlook for the next 6 to 12 months when it comes to sales, when it comes to the volume of your sales you're going to be doing, your business outlook? The answer they just gave is the worst on record. It's the worst since the 80s. It's worse than the recessions we've had in the 80s. It's worse than the dot-com bubble. It's worse than the great financial crisis answers on average. So how can people expect only a mild recession, if anything? How can analysts expect a 9% earnings growth this year? My pushback to that, David, is that when I see credit card spending picking up at the pace we have seen at the beginning of 2022, while the economy is slowing down, that's always been a consistent signal of people grasping for credit to make ends meet. It's not a sustained long-term rosy spending based on the fact that the economy is going to grow and your opportunity set is going to grow when it comes to economic returns. It's mostly about making ends meet. And so if you look at credit card spending, it has gone through the roof to make sure that despite real wages actually took a hit over the last 15 months, the average salary earned by an American, a Canadian, an Italian, a German, adjusted for inflation, has actually dropped anywhere between 3 and 5%. So basically, after inflation, you're able to buy less than you were 15 months ago. Yes. When that happens for so long, the only way to bridge the gap is via credit card spending and via spending all your savings you already accumulated, plus bridging the rest with credit cards. Not a good sign as well. I would say that you have to expect this recession to be at least equal to the median recession we have seen over the last 50 years, at least equal. And the median recession we have seen over the last 50 years has lasted 4 quarters in median terms and has seen S&P 500 earnings drop by 14% and GDP drop by on average 2.5% per year when it lasts. That's what you should expect, I would say, at the bare minimum. This should be at least a median recession, if not worse. Let's say, David, since November 2021, on the macro compass, people know that my asset allocation has been what I call my quadrant 4 asset allocation. I have this very simple asset allocation model that looks at forward-looking economic indicators, credit inputs and others, and looks at how central banks are in their monetary stance. Are they tight? Are they easing, right? And we were at the point when the Fed was telling us, I'm going to tighten up, and the economy was slowing down. In that environment, quadrant 4, it's the worst of all. You really can't do much. You have to have dollar cash, a lot of dollar cash. You have to sell all your speculative assets. Remember Bitcoin. Bitcoin was, I think, 50,000 when I came here, 45,000. I told you 26 was my next target. It's a speculative asset. It's an asset that needs risk sentiment to be strong, buoyant, to rally. That's exactly the opposite of where we are today. Equities as well. You stay away from risk as much as you can. You need to be defensive. Now, that has played well for 7 months. Dollar is appreciating, dollar cash is doing okay, at least preserving some of your purchasing power. You are avoiding losses. It's about capital preservation. It's about making sure your purchasing power remains as close as possible to where it was before the storm started. Now, are we changing here? Is there anything changing? Well, the economy is slowing down further. So from that perspective, sorry guys, but earnings aren't going to pick up. So you can't count on that. What about the Federal Reserve? So that doesn't help the front end of the bond market. But what happens is that if you go and buy third-year bonds right now, 10 third-year bonds, David, those bonds actually incorporate 10 or 30 years of inflation and growth. And if the Federal Reserve keeps pushing and smashing down credit conditions and making the recession worse, what happens is that later on in 5-10 years from now, they'll need to accommodate further, which means that if you buy these bonds today, 10-year bonds, 30-year bonds, you are capturing a pretty good entry point, I believe, because rates at some point will need to be cut to zero and stay to zero in order to recover from this recession we would have generated and worsened because of today's very tight monetary policy. So I've started to buy some 30-year and 10-year US Treasuries, 30 years at 3.25%. I started buying some of these because I think they would protect me during the upcoming recession. That is the only asset I am adding to my strategic portfolio. For the rest, plenty of dollar cash, no speculative assets. The time isn't here yet actually to buy those assets. Right now, I think it is still not time to leave Bitcoin. I would say the next price target I have is 15,000. It's probably going to even trade all the way down to 12,000 at some point. So there is some more pain to be had in all the pockets that benefited a lot from very strong risk sentiment and very cheap credit in 2021. You have to see all of that unwind and reverse. Once you clean up all the speculative longs, all the people that were enforced by these buoyant animal spirits to go and buy all these highly valued tech companies and, buying Bitcoin at any price. Once you clean that up, you'll have another rally probably later on. It's going to take a little bit. There is some more pain to be had in Bitcoin as well.